Hi, today I am going to explain another problem related to income from house property. Let me explain the problem first. Mr. Satish owns four houses. The details are as follows. So now here there are four houses. The first house of the annual municipal value of rupees 4,400 was occupied by him for his own residence. So it's used for own residence, occupied by him for own residence. He paid 1,000 as a interest on loan, 1,000 rupees as interest on loan taken to buy the house and 200 as a municipal tax. So first house is used for own residence. Then the next is the second house with the annual municipal value of rupees 6,600 was let out at rupees 600 per month. The second house was let out property and let out for rupees 600 per month. He paid a 600 as interest on money borrowed for the construction of a house. So 600 as paid as a money borrowed. So it is considered as a interest on loan. And 400 as a municipal taxes and 80 as a ground rent. Ground rent is not part of our calculation. So 400 municipal tax to be considered. Next, the fair rental value of this house, third house, the fair rental value of this house is rupees 2,000 and it is let out at rupees 150 per month. So third house is also let out property and rent is rupees 150 per month. The tenant agreed to bear the cost of repairs. There is a legal maintenance charge of rupees 2,000 per annum in favor of his sister. So let me decide it later whether it has to be considered or not. One point I want to say here is our calculation is always based on the provision or based on the format. If it is there in the format, then you have to consider whatever the provisions are given in the format, that items or that concept only we have to consider. All the materials which are given not required. Okay, let me explain the fourth one. The annual municipal value of this house is 6,000 and was let out at rupees 700 per month. It remained vacant for 3 months. So here there is a vacancy of 3 months in the previous year, and municipal taxes 600 were not paid. So not paid, municipal taxes not paid. So these are the details of four houses. The first point I want to say that you have to find out the nature of property, whether the properties are let out or self-occupied. How many properties are used as self-occupied and how many properties are used as let out, or how many properties used for business purpose or professional purpose or other purpose. So first you have to divide it, whether it's a let out property, self-occupied property or business property or professional purpose or any other purpose. Because our calculation is only related to let out property and self-occupied property, if the property used for residential as well as a let out purpose. So in this problem, the SSC used four houses. The first house is own residence. Okay, first house used for own residence, and second house let out property. Third house is also let out property. Second house also let out, and third house is also let out, and fourth house is also let out property. So out of four houses, three houses were used for let out purpose, and one house, means first house, is used for own residence, self-occupied. So there is no restriction, limitation for let out property. SSC can use any number of let out property. There is no restriction. Restriction is only for self-resident, self-occupied property. SSC can use at the maximum of two houses for residential purpose. If there is a more than two houses used for residential purpose, then we have to find out which properties are to be considered as a self-occupied and which are to be considered as a let out property. So that I have explained in the previous classes also. Here there is no such problem. Four properties: first house self-occupied, second house let out property, third house let out property, and fourth house is also let out property. Out of the four houses, one house is a self-occupied and three houses are let out property. So let me start the calculation. Here it is the solution for the house A or first house. It's given in the problem as like a first house, but I have considered as a house A, that is a self-occupied property. House A is a self-occupied property. This is the format for the self-occupied property. It begins with the net annual value. Net annual value is always nil. It is a fixed. Okay, net annual value of self-occupied property is nil. Format starts from net annual value. This is only the format. No other details related to the format of self-occupied property. So first house is self-occupied property. Net annual value is nil. Then comes deduction under section 24. Only one deduction, that is interest on loan. If the loan is borrowed for the construction of house or for the purchase of house, then you have to find out 1/5 of pre-construction period interest and interest on loan in previous year. If loan is not borrowed, if there is no information regarding whether the loan is borrowed for the construction of the house or for the purchase of the house, then you can consider whatever information is given in the problem. Say in the problem it is given, it is used for a own house, for a own residence, and 1000 as paid as interest on loan. The total interest on loan paid in the previous year was rupees 1000. So it is directly given. No need to calculate 1/5 of PCP interest as interest on loan in previous year. This calculation comes whenever the loan borrowed for the house construction or the house purchase is given in the problem. If there is no such information, then whatever interest on loan, if it is given, then you can consider. Even if the interest on loan is not given, then you can consider it as a nil. So in this problem, the interest on loan is directly given, so 1000 rupees. So that is a deduction under section 24, 1000. So it's a loss from house property. Of course, in self-occupied property, you won't get any income. It is used for residential purpose. So therefore, of course, you will get the loss only. So loss from house property, it is a 1000 rupees is a loss. So that is how to assess net annual value or income or loss from house property in case of self-occupied property. Now we will calculate the income of second house property. The second house is let out property, which I already told. The second house, house B, is let out property. Annual municipal value 6600. No fair rent, no standard rent. Standard rent not applicable, and fair rent is also not applicable. So therefore, municipal value itself is the expected rental value. No other values here. No fair rent, no standard rent. So therefore, directly municipal value itself is the expected rental value. Whenever the values are given, then you have to apply the clause. So 6600 is the expected rental value. Then comes rent received. Rent received or receivable for a let out to duration. So the house B, the second house, was let out at rupees 600 per month. It was let out at rupees 600 per month. So total for 12 months, throughout the year it was let out. So 7200 is a rent received. Let out for 12 months, 600 into 12, 7200. Then next, unrealized rent. It is not applicable here. No unrealized rent. So unrealized rent is not given. So therefore, rent received is 7200. 6600 into 12, rent per month into 12, 600 into 12, 7200. No unrealized rent. So total rent received is 7200. Now the next stage is the gross annual value. If first provision, expected rental value or rent received, whichever is the highest is a gross annual value. Higher of two, expected rental value or rent received, whichever is highest is a gross annual value. So here is a 7200. No unrealized rent and no vacancy period in case of a house B. So therefore, higher of two is a expected rental, gross annual value. First clause of the gross annual value. Next is a less municipal tax paid. It's a 400 rupees. 400 total municipal taxes which was paid. 400 as municipal tax paid. If it is paid only, it is deductible. So 400 rupees as municipal tax. So after deducting municipal tax from gross annual value, you are going to get net annual value. It is a 6,800. So net annual value is a 6,800. Next comes deduction under section 24. So let's deduction under section 24. For let out property, there are two deduction. One is in standard deduction and another is a interest on loan applicable for let out property. First one, standard deduction. It's always 30% fixed, 30% on net annual value. So here in this problem, net annual value is a 6,800 into 30%. So total standard deduction is 2040 is the standard deduction. 30% on net annual value. Net annual value 6,800. 6,800 into 30%. So it is 2040. Next is the interest on loan. In this problem also, in this house also, loan borrowed amount is not given. Direct interest amount is given. It is he paid 600 as interest on money. So interest on money borrowed for the construction. So total interest on loan is paid by SSC rupees 600 for the previous year. So 600 as interest on loan. This 1/5 of PCP interest and interest on loan, these two are not required because loan amount is not given. Whenever loan amount is given, then only you have to apply these two. So interest on loan 600 per month directly given. So after deducting standard deduction and interest on loan from net annual value, SSC is going to get income. The income rupees 4,160. 6,800 minus 2,040 and minus 600. Net annual value less standard deduction less interest on loan. The balance is 4,160 is the income of house B. So this is the structure of a format of a let out property. And you can calculate separately, which will help you to easy for the calculation. Even you can calculate combinedly, but whenever there is a lot of other calculation related to rent received or interest on loan, then you will find it difficult whenever you combine, whenever you calculate combinedly. So calculate separately whenever there is a lot of information related to house properties. So that is about the income of house B or second house. Next, house C. House C is also let out property, as like I told. House C means third house. Third house is also let out property. Here municipal value is not given. Fair rental value of the house is given. Fair rental value of the house rupees 2,000 and standard rent is also not given. So municipal value and standard rent not applicable. So therefore fair rental value itself is a expected rental value. So 2000 is a expected rental value. Again, if all the values are given, then you have to apply the clause of the expected rental value. Otherwise, whatever values are given, that itself is the expected rental value. Next is rent received. Rent received. So it was let out at rupees 150 per month. It is a let out property, as like I told. 150 per month let out monthly rent, and it was let out for throughout the year for 12 months. So 150 into 12. So rent received is 1,800 per annum total rent received or receivable. And unrealized rent is not given. No unrealized rent. So it is not applicable. So after considering unrealized rent, the rent received or receivable is 1,800. Now next is the gross annual value. So first provision of gross annual value, expected rental value or rent received, whichever is the highest, is a gross annual value if there is no unrealized rent and vacancy period. Higher of 2 is a 2,000. 2,000 is the highest. Higher of 2 is a 2,000. 2,000 is a gross annual value. Next, municipal taxes paid is nil. No municipal taxes given here, no municipal tax, so it's nil. So net annual value is a 2,000. It's going to remain same. Gross annual value and net annual value is the same here because no municipal taxes. Next comes deduction under section 24. Again, there are two deduction applicable for let out property. One is the standard deduction and another is the interest on loan. The standard deduction is always 30% on net annual value. Net annual value was rupees 2,000. So 2,000 into 30%, 600 is a interest standard deduction. It is a fixed 30% and always on net annual value, applicable only for let out properties. Next is the interest on loan. No information regarding the interest on loan. Either a direct amount is not given or even a loan amount of the house property also not given. So therefore interest on loan is nil here. So total after considering standard deduction and interest on loan, then the balance amount or a balance 1400 is considered as a income from house property. 2000 minus 600 is balance, that profit he is going to get the profit, that profit is rupees 1400. So whatever the other informations are given in the problem are not required, as like earlier I told. There may be lot of information given in the problem, but all the information is not required. So we have to calculate as per the format. Whatever format or whatever provisions is, that information only we have to collect. So therefore here other informations are considered as a irrelevant. So whatever information required for our calculation, that we have considered. The balance amount after considering all the information, the balance is 1400, and 1400 is a income from house property. Next is a house D. It is also let out property, same like other house B and house C, fourth house. The municipal value is given AMV, annual municipal value 6000. No parent, no standard rent. So therefore municipal value itself is the expected rental value. 6000 is a expected rental value. So it is also let out property, as like earlier I told. So let out at rupees 600 per month. It was let out at rupees 600 per month, but there are 3 months vacancy. Okay. In case of house D, it was let out at rupees 600 per month. So total let out duration is 9 months only. So 12 months rent received or rent receivable is for 9 months only. 12 months minus 3 months vacancy unoccupied. So rent received or receivable is only for 9 months. So that is 700 into 6 months. So sorry, 9 months, total 6300 is the rent received or receivable. Why for 9 months? Because of vacancy for 3 months. House was let out only for 9 months. Rent can be received only for 9 months. So that rent received or receivable for 9 months is rupees 6300. Next is unrealized rent. So not applicable, no unrealized rent. So after considering the unrealized rent, then rent received is a 6300. Rent received is 6300. Now next is a gross annual value. So whenever there is second clause is applicable here, whenever there is unrealized rent and vacancy period, rent received itself is a gross annual value. So here vacancy period are there 3 months. So 3 months vacant, house was vacant. So therefore rent received 6300 itself is a gross annual value because of vacancy period. So whenever unrealized rent and vacancy period are given, then gross annual value is equal to rent received, the second clause of gross annual value. Next is a municipal tax is a nil, no municipal tax. Next, net annual value is 6300. See why I have not considered municipal tax. It's given in the problem. The municipal taxes of rupees 600 but were not paid. So you can deduct the municipal tax from gross annual value whenever it is paid. If it is paid only, it can be deductible. Of related to present year or of next year or of previous year, it can be deductible, but it should be paid in the previous year. It should be paid. If it is outstanding, if it is a due, if it is not paid, then it is not deductible. So here also municipal taxes are given. It's 600 rupees, but which was not paid, means it is outstanding in the previous year, not paid. So therefore it's considered as a nil. So then after considering the municipal tax, net annual value 6300. Next comes deduction as usual in case of earlier properties I told. Deduction under section 24. Let out property, 2 deduction. First one is the standard deduction. 30% on net annual value. Net annual value 6300. 6300 into 30%. So 1890 is a standard deduction. And interest on loan here also not given, so nil. Interest on loan is not applicable here, so nil. So after considering the standard deduction, the balance 4,410 is considered as an income from house property. So in case of 4,000, there is also income, it's rupees 4,410. So house B and house C and D, the calculation structure is the same, only changes in case of values, only changes in case of some statements, but format is the same from municipal value till income from house property. All the formats or structure, whatever entering the values or the structures are the same, only changes in values. Municipal value, fair rent, standard rent, expected rent, rent received, unrealized rent or vacancy period, gross annual value, municipal taxes, then net annual value, then deduction, standard deduction, interest on loan, then 1/5 of PCP interest, interest on loan in previous year. All procedure is the same. Just you have to enter the values which are given in the problem. So that's all about house D. So this is a total calculation. So we have to calculate total income or loss from house property. House A carries 1,000 rupees. House B 4,001. House A loss, it is 1,000 loss. Whereas in case of house B there is a profit of 4,110, and house C is 1,400. House D is a 4,410. And total income, it's a total income. There is no after a set off of loss of first house, then the balance is called as income. It's income from house property, it's rupees 8,970. So this is how to calculate income from house property whenever the different information or different materials or different features of house properties are given, and how to calculate income from house property. My suggestion is you calculate separately, house A separate, house B separate, house C separate, or D, or any number of houses are if given, you calculate it separately. Earlier I have calculated combinedly because only some stages I have calculated related to gross annual value or related to only the net annual value, where the informations are the same, similar values, only the more number of properties were given. But here informations are different for all the properties. So therefore I have calculated separately, and there are some calculations also, so which will help you to easy to understand. So that's why I have calculated separately. Again, my suggestion, calculate separately whenever there are more number of houses are given, or whenever there is a calculation of last stage, that is a income from house property. Whenever you want to calculate income or loss from house property, then calculate separately. Thank you very much.